to Mortgage Markets and More. I'm your host, Peter D'Angelo. I hope you're doing well and that you're having a fantastic week. I've got your update here on mortgage rates and a little bit of real estate market updates. I'm excited to note that next week I will get the National Association of Realtors publicly released existing home sales data, and I will be delivering an episode as soon as possible to report out on that. I'm really chomping at the bit to see what September is going to look like. So I will keep you posted on that next week. But for now, I've got your mortgage rate update. We're going to do our customary review of the bond market first, and that sets the stage for our mortgage rates. Then we'll get into a little bit more of the why behind what's going on. But I'm going to bury the lead here. Ho-hummery comes to mind, which I welcome. It means that there hasn't been a lot of great shakes happening, not a lot of market movement. There hasn't been enough really released by way of data. We've had earnings calls from the end of the third quarter, the financial quarter. So that's been having some effect. But as far as us, when it comes to real estate and when it comes to mortgage rates and the bond market, kind of the status quo for right now in this little bit of an elevated environment. So let's start with our bond market review. 10-year Treasury bond, as of recording this episode, the Thursday morning before its release, 4.016% for the 10-year Treasury yield, a little bit lower than last week. The 5-year Treasury yield is at 3.844%, again, a little bit lower than last week. And the 2-year Treasury is at 3.94%, again, a little bit lower than last week. And we see now that 2-year Treasury yield is a little bit lower than the 10-year. However, it's still a little bit higher than the 5-year. We still have what's called the inverted yield curve. So we'll have to see that flatten out and normalize, and then we start to see that there's more of a normal occurrence in the market, and we're starting to see some stabilization, right? Shorter money should not be as valuable as long money, right? Now, let's take a look at mortgage interest rates. These are the averages as reported by Mortgage News Daily, again, the Thursday morning before the release of this episode. The 30-year fixed rate mortgage is at 6.63% on average. The 15-year is at 6.07%. The 30-year jumbo is at 6.74%. The 30-year FHA is at 6.1%, and the 7/6 SOFR adjustable rate mortgage is at 6.53%. So, taking into account where interest rates are just a touch lower than where they were, we're still on the bottom third of average of mortgage rates over the past 52 weeks. So still it's a lower rate environment than the highest points that rates have been at over the past year. However, we're still in a comparable mortgage rate environment as mid to late July of 2024. Why has there not been much movement? What's been going on to support where the market is right now? Let's get into that. We identified a few things that were going to be released, some data points that are key that were going to be released after the recording of last week's episode. So let's talk about a couple of them. First up is the initial jobless claims. Jobless claims for the October 5th report showed 258,000 initial jobless claims. That is up from the expectation of 230,000 and also up from the previous reading, which was at 225,000, showing a little bit of weakness in the employment side of things. However, the CPI, Consumer Price Index, which is a quick reminder, is one of two major inflation gauges. The Federal Reserve's preferred inflation gauge is the Personal Consumption Expenditure, PCE. That report's due out toward the end of the month. However, we did get the Consumer Price Index, the CPI, and that came in last week after recording the episode. And here is what it reflected: the mixed bag. We had a 0.2% price growth month over month on the CPI. That's up from the expectation of 0.1% growth. However, it is the same as the last reading for the prior month of 0.2% month over month. The year over year was 2.4%, slightly up from the expectation of 2.3%, and also down a little bit from the previous reading of 2.5%. So this is where the mixed bag starts to show itself. Now, the next part is really where, when you're looking at inflation, it's tough to say if there's valuable movement happening downward. And that's when we talk about the core CPI, the core Consumer Price Index. The core essentially removes volatile elements that are otherwise included in the pricing comparisons month over month and year over year. So things like food and energy are taken out. So the price of gas, the price of meat, whatever it may be, whatever falls under food and energy, that gets removed, and that gives us what the core CPI is, and that came in at 3.3% year over year, which is up from the expectation in the previous reading of 3.2. What that's telling us is that there are things, particularly the prices of the volatile things, energy and food, that in the data set have helped to kind of counterbalance the growth of the core items. So that counterbalance got us to 2.4% year over year when we're talking the headline, the full reading of the Consumer Price Index. I'm more interested in seeing what happens with the PCE at the end of the month for us to get a sense of what the Federal Reserve may be doing. However, it's pretty much baked in right now that there's a very low expectation for further rate cuts by the Fed from here to year end. More on that later, but right now, there's not a lot of optimism around further rate reduction. And so that's why we have the current mortgage rate environment that's kind of stayed stable after we saw the jobs report that really started this whole rate upward swing. And until we start seeing more cooler inflation categorically, not this mixed bag, and also unemployment kind of needs to hang out where it's at, because it's been evident to us now that the Federal Reserve is much more sensitive to effects in the labor market than necessarily inflation coming down, because now we're really close. The last reading on the PCE was extremely close to the 2% target. We're looking at the CPI, 2.4% year over year, pretty darn close to the target. While we're talking about inflation in particular, I wanted to make mention of a couple important things. One, inflation readings are a comparison of price month over month and year over year. If things were expensive a year ago, they're going to be just not as more expensive, not much more expensive when you see something like a 2% or 2.5% increase in the price. It's still being compared, though, to the high price from a year ago, and that's being compared to the high prices a year before that. For us to see any relief, we'll hear about inflation's coming down, and you'll go to the grocery store and you'll be like, well, I'm not feeling it. I'm still paying so much more money for my groceries for myself or for my family. That's because inflation is a growth rate reading. It's not showing you that prices are actually coming down. It's more about the stabilization of prices, which is really the point right now. We're trying to reach a point of price stabilization so that inflation cools to the proper level, and then the Federal Reserve can kind of start taking a back seat, and their monetary policy won't influence the market as much as it is. Because currently, the market's hanging on every word of the Fed and every mention of their policy and indication of what they may do next. The other report that we got last week was the Producer Price Index that came in flat month over month, 0% growth, and the expectation was 0.1% growth, and previously it was 0.2%. So PPI, Producer Price Index, is kind of your first bellwether to let you know about where prices could be going for inflation readings like the CPI. So this showing flat is somewhat of a silver lining, some good news. And year over year is 1.8% growth, which it was 1.9% previously. So there's a cooling effect happening in the PPI that could trickle down to the CPI in future reports. These are the factors of why we had a ho-hum week. There was nothing really indicating one way or the other. Initial jobless claims picked up a little bit. Inflation's cooling, but there's parts that aren't as cool that are still running hot. But on balance, it's still cooling a little bit from the data. It is what it is. So we're going to be really taking a look at what's going to be happening next to see if that's going to move anything. The only potential movers I am seeing on the radar right now before next week's episode, and I'll report out on this too, is retail sales. So we're going to see how retail sales numbers are looking, and then jobless claims again. It's a weekly report. So that gets released today. I'm recording this in the morning on Thursday on the 17th. So when that gets released, I'll report out on it next week, and then we'll actually see if that's evidencing why something happened in the market, or if we have continual stabilization of where things are right now. Some quick notes, and I'll just call this kind of like a fun fact section for the episode today. Since 2021, the monthly mortgage payment on a $400,000 loan has increased by $838 per month due to rising rates alone. So the cost of what this financing has gotten that much just purely by a function of $400,000. Same loan amount compared from 2021 to now. That's just stabilizing the loan amount. Home prices have gone on appreciation. So to give you an idea, that's why there's this affordability crisis. That's why when there's a lack of inventory and people have to be very competitive, it's very difficult to compete, because take a look at how much more expensive the financing's gotten. We're hopeful that rates are going to start coming down, and that will hopefully stimulate activity in the market. But I thought that was a fun fact to share, to kind of show a comparison of why the affordability crisis is so prevalent right now, beyond the inventory issue. The other item I wanted to share was that experts are suggesting that rates are not going to change drastically, and definitely not going to happen soon. Most of the predictions from experts right now are seeing interest rates anywhere between 6.5, a best case scenario from here to year end. As mentioned before, we're above 6.5 slightly. 6.63 is the average for the 30-year conforming conventional mortgage rate as reported by Mortgage News Daily. So let's set that expectation. If anything happens where we get lower interest rates, that's gravy. That's a benefit. For now, let's set our expectations in this 6.5% range, plus or minus, and we can manage accordingly from there. Still very reasonable. It's not 7.5. It's not close to 8%, which is where we topped out with rates. And it's just good to know that we should be stabilizing here. There are other things that can happen that can affect interest rates beyond the bond market and some of these economic data points that I've been mentioning. I've mentioned on past episodes about geopolitical risks. Those geopolitical risks will have influence and impact on the market one way or another. Those are things that we can't anticipate. But the data that we're sharing and the data that we're talking about, these are the primary things that are going to be moving people's expectations. And again, expectations create the rate environment that we have. That's how this works. That's why the Fed cuts the interest rate by 0.5%, and interest rates don't do anything, and then a week later, they go up. It's expectations. Remember. Now, did you know segment of the show? This one's a fun one. We're going to pull apart some things when it comes to first-time homebuyer loans. So, did you know that there are a number of first-time homebuyer loans that are available to you if you have not been on title to a property for the past 3 years? It is true. However, some important things to note. Some of these first-time homebuyer loans have a range of benefits. One end of the spectrum is reduced interest rates. So, having accessibility to some of these first-time homebuyer loan programs, you just get a discounted interest rate because you're a first-time homebuyer compared to somebody moving up or downsizing, purchasing a home using financing, conventional financing, or FHA. So you have that. On the other end, there could be reduced interest rates. There could be grant money offered to you, down payment assistance. Both ends of the spectrum are available to first-time homebuyers. Here's the catch and here's the caveat. There are a couple that are very unique that we particularly offer that don't take into consideration, or area median income isn't taken into consideration. That's what I wanted to talk about. So most of these first-time homebuyer programs actually require you and all of the applicants on the application to not make over a certain prescribed level of income to be eligible for these programs. I'm here in North Jersey. By a pure function of the math, sometimes these loan programs aren't even accessible because the income required, unless you're putting a hefty down payment, the income required to afford is higher than what this area median income indicates. The area median income is available to us through tools so that we can look that up. However, it's something publicly available too. So Fannie Mae and Freddie Mac, they have their demographic information publicly available. That's where we go to look as well. We look that up for the property address. There is one very premier first-time homebuyer program that we offer that actually goes based on where your current address is and then does not have any area median income implications, and there's grant money available. If these sound interesting to you, I encourage you to reach out, or if you're working with a mortgage advisor already, bring these up. Ask if there are options available to you as a first-time homebuyer that could help you with a discounted interest rate or grant money. The second element to that is some of these programs, particularly the programs that are offered through any state agencies. The state of New Jersey offers some first-time homebuyer programs with down payment assistance. Beyond the caveat of income being considered and you not being able to be eligible if you make too much money or there's too much money in your application, the other element is if you are eligible and you are able to get that grant money, a number of these programs have restrictions when it comes to the timing for refinance. So if you decide you want to refinance in, let's say, 5 years or something like that, there could be a restriction where then that grant money needs to be repaid. So there's a seasoning requirement. You can get the money, but then there's that caveat. Just worth considering all options. Sometimes it makes sense to do that, especially if that's what's required to get you into your first home. Go for it. Other times, you may not want to be hampered by that timeline, and then you won't be able to refinance if and when rates go lower, which most people purchasing right now are hoping that they can realize some monthly savings in time when rates come down, and with their property appreciation happening as well in that timeline. That's really why there's a benefit to shopping now, right? So that's our Did You Know segment of the day, and that's it for the show. I appreciate you all listening. If you have any questions, concerns, or things that you would like brought up on the show in particular, things for me to deep dive on, you're encouraged to reach out to me. Please send me an email at peter.d'angelo@rate.com. All of my contact information is in the episode description. I'll be back next week with your regular update. I'm going to try my very, 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 very best to get your National Association of Realtors existing home sales data as soon as possible after the release of that data. So we may have a double whammy next week where we get 2 episodes back to back, but I will get that out as soon as possible. In the meantime, if you're a home shopper, happy shopping this weekend. I hope the weather warms up just a little bit to help you when you're going out there to see open houses. If you're a professional, best of luck with all of your clients and all of your endeavors this weekend. I look forward to talking to you all next week. Have a great weekend.